Welcome, 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 everybody, to the Not Your Average Investor Show Thursday edition. Rental property of the week. Today, we're going to go over a property that is brand new construction. It is only 4 miles from a $600 million mixed-use development that I know GC is particularly jazzed about, and it's going to generate over 7% ROI. Right now, GC, we are definitely live on Facebook for the Thursday edition of the Not Your Average Investor Show, the Rental Property of the Week. I am your host, Pablo Gonzalez. With me, as always, the man with the echo, the man that we call GC because he's got genius concepts, because he knows how to generate cash flows, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hey, everybody. Great to be with you.
It is great to be with you too, buddy. And great to have the Not Your Average Investor family into his house right now. And as we like to say, if you want to find out about how to own rental properties in a portfolio, in an investment portfolio, you're in the right place. If you want to find out about the best property management practices for rental property investors, you're in the right place. And if you're trying to get an edge in the Jacksonville market, which is the hottest market in the US right now, you're in the right place. Next place to go is chat with JWB.com to really personalize it for yourself. Talk to our team. It's going to be awesome. But right now, we're about to do the roll call. Ready, GC?
Game on.
John Henning, good afternoon. Lee Bishop, how punctual you guys always are on these calls. Good afternoon, Lee. Thank you. We pride ourselves in punctuality around here. Carl Thompson, hey, everybody. Good morning from Colorado. I bet you it's real nice in Colorado. Jen Filzen, godmother of the Not Your Investor Show family, says, good morning, JWB family. Lydia Filzen, mother of the godmother of the JWB Investor Show family, says, hi, gang. Hey, Lydia. Dean Curry from Columbus, Ohio is in the house. Chris Gonzaga. Hello, everybody. Good to have you, Chris. Ken Moline, past show guest legend. Good morning from California. Who else is here? Nadeem Shah. Good morning, good afternoon. Nadeem joining us from the West Coast as well. Hervé Francois from the Dirty Jers. Good to see you, Hervé. Happy to have you back with us. Good afternoon. Carl Thompson says it's chilly today. And over there, Peter James is here from Virginia. Welcome, Peter. Good to have you on board. And let's kick it off, GC. Before we kick it off, I think we got a little beep breaking news for folks. Tell them, GC.
It is some breaking news, and it's the best type of breaking news. We are going to be talking about the JWB Cares home donation, what we are cooking up for 2022. For those who are new to the show or new to JWB, we are very big into giving back in this community. We feel like it's a responsibility that we have, and it's something we get to do with the platform that we have to really change people's lives. And it is the single best day of when we get to do this. And the way we do it is we build new construction homes and then we give them away to folks in our community that could use a helping hand. And we've done this for 4 years now. And the last 3 years, we have raised enough money from us, from our network, from our sponsors, from all of you to be able to build a brand new construction home and give it away. We've given 3 homes away to 3 warriors through our partnership with Canines for Warriors, 3 veterans who needed a helping hand with affordable housing. And so now those 3 veterans have a brand new, beautiful new construction home. And it has absolutely changed their lives, and it's changed all of our lives in the process, being able to be a part of it. And we couldn't do it without all of your support. So I have some really exciting news. In 2022, we are planning not to do just 1 home. We are planning to do 2 homes. And it's something that we have been working really hard at for the entire year to be able to raise enough funds and to be able to partner with the right organization so that we can give the most help. So we are, of course, continuing our partnership with Canines for Warriors, but the second home that we'll be giving away is through our partnership with the Tim Tebow Foundation, which we're so excited to partner with this wonderful organization, specifically to help in the fight against human trafficking. And so our first home will, of course, be continuing our partnership with Canines for Warriors, and we'll be working with Canines to be able to select a very deserving warrior to be able to get that brand new construction home. And that'll be in February, March timeframe of next year. And the second home will be given away to a recipient within the Tim Tebow Foundation. So we're super stoked, super excited. Thank you to all of you for your support. And let me just tell you how much you guys have supported already. Like Pablo, me and you were talking about this right before the show. And when I mentioned the amount of money that we've raised so far, what was your reaction?
I was pretty impressed.
Yeah, man. Yeah. This idea grew out of nothing. To be able to do a charity golf tournament, to be able to raise enough money, to be able to help some folks. And now we're raising enough money to be able to build homes and give them away, not just one, but two. So up to date this year so far, we have raised over $90,000. That's going to go directly towards building these new construction homes. In fact, our goal for 2021, our goal for raising was $100,000, is $100,000. We are just $4,400 short of hitting our goal for 2021. So first and foremost, thank you to all of you out there who have donated and who have supported. Thank you to all of our sponsors who have already signed up and are going to be there on the day of the charity golf tournament, which will be in February of 2022. And I'm also going to ask all of you to join. If you have donated, if you haven't jumped in, if you haven't been a sponsor, if you haven't been a part of this wonderful cause, I really would love for you to consider it. Right now, we are asking for donations, and we can do this. It's if you go to jwbcares.org/sponsor and you choose to donate, it would mean the world to me and to my team, as we hope to be able to raise enough money to be able to do 2 homes this year and maybe more next year. It's a direct reflection of all of your support to be able to do that. So we're $4,400 short and would love any of your support. And if you want to give that support, Pablo, you've been asking me about doing more swag on the show for a long time now, right?
I have.
Well, you know what? Ask and you shall receive. So I grabbed one of these fancy, not your average investor show polos that some folks in the group have been asking about. And for any of you who are gracious enough to donate here today on the show, you're going to be getting a fancy, not your average investor show polo. We'll get that right out to you. So you can go to jwbcares.org/sponsor. Go there right now. And if you do it during the show, tell us, put it in the comments. Just tell us that you donated. That way we'll put a little list together. We'll reach out and then, of course, get your shirt size and get your shirt to you. Man, would love to just to share the support that we have with the community. So thank you in advance. And I'm super, super excited for this year.
There you go. I just shared the link in there probably about like 4 or 5 times in the chat because the chat moves so quickly. It's easy to click on. I'm going to show you where it is. Lee Bishop, always helpful, always with good suggestions, is saying put a minimum on that. And there is a minimum, Lee. So it's defaulted to $100. If anybody donates $100 or more, you get the shirt, right? GC, you get to have Not Your Average Investor Show swag.
Absolutely.
Jen just said, Renee and I just donated. All right, Jen, you're the first one on the show. You get some more shirts to give to your friends, or maybe you need a Tuesday, Wednesday shirt. I don't know. Now you got one for each day of the week. That works. This is the page here. GC, is there anything that you want to go over as far as the page and what we're showing here?
No, I mean, the donation thing is right there. Yeah. If you are a business or if you're somebody that would like to sponsor the actual golf tournament, there's that option there too. So there's the birdie sponsor package. There's sponsor packages, I think, from maybe about $500 up to $20,000 if you're going to be the presenting sponsor. And so, of course, would love to have all of your support there. Sponsors are, of course, the number one way that we're able to do this home build. And so we would love all of your support there. Jen and Renee, thank you for being the guinea pigs. Thank you for sharing as well here on the show. I know that encourages others, and just thank you guys. It means a lot.
There you go. So you got multiple options to donate. You can just donate there. Lee is also donating today. Thank you, Lee, very much. And I don't know, GC, I might have to look at these sponsor packages and look at my marketing plan for this year and see what we do. Maybe there's a good referral in there for Be the Stage as the producer of the Not Your Average Investor Show. I think it makes sense. I think it makes sense to me. So we'll figure it out, man.
Awesome, brother.
All right. So now we go magically with, I always forget this because I'm always so pumped up. But if you want to follow along today and you want to, hey, Denny Davis is donating now. Love this program. Thank you, Denny.
And just saw John Henning too. And Hervé Francois. You guys are amazing. Thank you, guys.
It is amazing. Hervé, only we saw that though, because you're chatting to hosts and panelists instead of everyone. So let everybody know Hervé just donated as well. And now from now on, if you want to chat with everybody, just change to everyone, this is really cool, man. I love the live auction format for charity. Great cause. Veteran receiving a home, somebody escaping human trafficking, receiving a home. Very, very noble causes. Amazing to be a part of this. I've donated as well. Definitely going to be at the golf tournament, February 2022.
Yes, I think it's February 28th.
February 28th, 2022. You'll get to see, I don't want to jinx it, but GC is playing the best golf of his life, y'all. So he, by the time we get there, he might just do like a couple hole-in-ones in a row. You never know.
I might have like 10 golf trips between now and then too, to even get better and better and better. So I don't know how you feel about that, Pablo.
You know how I feel about that, Greg. I'm always happy for you to be happy and also really butthurt when you leave me. All right. So here we go. We're going to go. Oh, if you want to follow along with the property today, go to, all right, Chris Gonzaga donating today as well. Love this, man.
Nadeem
awesome.
Shaw also said that he's donating. Thank you so much.
Very cool. Very cool. All right. So if you want to follow along today, you want to download this property sheet, you want to fiddle with these numbers, go to jwbinventory.com. You can download the sheet and you can mess around with it. It's I get to play with it every single week on the show. It's a powerful, powerful tool because it has all the assumptions that you need, everything that you need to break down any kind of property deal. So you can always just use it as a template for anything else that you're investing in as far as rental property goes. And you can do it that way. And without further ado, we're going to get to the POTW, which is magically whisking us away to 4719 Spring Glen Road. That's in the 32207. $275,000 is the price point on this house. It's a new construction. Let me know in the chat if it's clear, if I got to zoom in, zoom out. 4-bedroom, 2-bathroom, 2-car garage, lease for 2 to 3 years for $1,700. And then what we always like to talk about here is this total monthly cash flow that you get of $171 and this total ROI of 7.75%. GC, I want to do something different. We always dive into, the widget of this thing and how it's this like asset of cash flow. But I want to ask you today, what about this property in particular gets you pumped up, buddy?
Well, for fans of the show too, it's not, you will not be surprised in the first part of my answer here, which is that all JWB properties fall into the same box. And by default, I love all of our properties because we only operate in a very small box in a very small window. And I love that box. I love that window, right? I love that set of criteria that produces positive cash flow, that also has risk mitigation built in, that also has an opportunity for upside. And that's what you get when you invest in a market like Jacksonville with a team like ours. So I love that about this property, right? We're going to go into the positive cash flow here. We're going to go into the other profit centers, including tax savings, principal pay down. We're going to go into home price appreciation and, of course, inflation hedging. This property has that. It's in one of JWB's core neighborhoods, which is the South Side. But within all of our neighborhoods, I've been trying to just pick out little bits of information or projects or very cool things that are happening within these very specific neighborhoods to point out and reflect what we talk about often, that this is a place for jobs. This is a place for growth. And so this property here on Spring Glen is located 4 miles away from some very big developments that are going on along the south bank of Jacksonville. And I'll kind of show you where it is on a map here in just a second. But only 4 miles away. And I put together some of the information on just a couple of them. One of them is the $600 million mixed use development. This has been in the works for, I believe, 10 or 12 years now. And it's finally breaking ground. Now it's called River's Edge. And River's Edge has, let's see here, it's a riverfront site right on the St. Johns River, right on the south bank of downtown Jacksonville. It's going to be turned into 950 apartments, townhouses, and condos, 200 hotel rooms, 200,000 square feet of office space, 121,000 square feet of retail space, 125 marina slips, and a waterfront park that will be open to the community. Right? If you're investing in an asset that you can still get positive cash flow because prices are so low and rents are so high, that is less than 4 miles away from a development like that, do you think that you're poised for some growth, for some upside?
I would assume so, yes.
So let's take a look at what that looks like. Pablo, do you want to, here, I'll bring up the map here.
Why don't you
And I'll
bring up the
show you
map?
guys.
And while you're bringing up the map, you were telling me this is by the Related Group, right? Like this is a developer that I'm very, very familiar with. It was founded by the richest guy in Miami, this guy, George Perez. They've been doing this mixed use stuff for a while now in Miami with great success, right? So when you told me that name, I got a little bit starstruck. So to be close to a development of that ilk, I think is something that is worth mentioning as well.
Well, let me throw you a little bit of a curveball. So what I was talking about with the Related Group isn't even this project.
Oh,
the Related Group is a separate project that's right next to this one.
Okay.
So this one is not the Related Group. It's a partnership here of some developers here in Jacksonville. So not the Related Group. But let's talk about this one here. It formerly was named the District at South Bank, but this is the project that I was just describing there. River's Edge is now what it's named. Google's a little bit late to the game, right? The property that we're talking about here on Spring Glen Road is right here, right? Less than 4 miles to get there. Now, Pablo is a perfect segue to talk about the Related Group's project, which is one of the first projects in Jacksonville for the Related Group to come. So when you see big time national developers coming into Jacksonville, they see big opportunity. They see the same thing you and I see as far as low prices, high rents, and big upside, right? So the Related Group is actually doing a project here for those who are native to Jacksonville or know Jacksonville well. A River City Brewing Company was next to Friendship Fountain, which is right over here on the South Bank. And it just never really maximized its potential as this wonderful restaurant on the water that just didn't get the love it needed for a long time. So that restaurant has closed, and Related Group is coming in and going to put in a $92 million development. And they're going to have 335 apartments. And so when you see somebody like the Related Group come in, make an investment and hold on to assets, right? Apartments mean they're holding on to it. It's for the same dynamics that you guys and I talk about all the time. So another one on top of the River's Edge that's 4 or 5 miles away from this house on Spring Glen.
I don't want to interrupt you, Greg, but Marilyn Cotterman from Homosassa, Florida,
home of the manatees,
just donated. All right, thanks.
Yes, that's always. Please interrupt me. That's amazing, Marilyn. Thank you very much from the bottom of my heart.
Yeah, and listen, is putting in the chat here. Doesn't these big deals create more competition for rentals?
Do these big deals create more competition for rentals, right? So that would mean that it increases the supply of rental housing. Yes, it does increase the supply of rental housing. But what we're dealing with right now is an extreme lack of supply in rental housing. That's why these big developers are coming in. That's why you're probably thinking about coming in, right? Because you're looking at low prices and high rents, right? So is one or two, developments that are going to have 500 to 1,000 units of apartments going to completely change and flip this market from being extreme lack of supply to oversupplied? No. There's a lot of room for growth there.
Yeah, got it. So it's also a different type of tenant, right? Like I know that what Related develops in Miami is not something that I usually could afford in Miami. So, and these are like high priced luxury apartments, stuff like that. People that rent a home in a JWB home is generally not that person, right?
It's a wonderful point. You're absolutely right. So these are going to be luxury apartments. If you see marina slips right next to your, apartment or your townhouse or condo, right? That is not going to be typical for the cash flow properties that I put in front of you. So we are investing in a below middle income neighborhood 4 to 5 miles away from River's Edge or from the riverfront. And that type of housing is going to cost a lot more and will be attracting a different type of renter. So you're absolutely right there.
You want to throw that map up again? Because I just kind of want to go through, as somebody that is, now I'm local here and I'm starting to understand Jacksonville a little bit better. Where is this thing? All right, cool. So you got the map up there. This area down here, right? Like this is St. Marco. This is a live, work, play, walkable neighborhood with really nice houses. Over here is that River's Edge where they're going to put some nice condos and mixed use development. So what's happening is a bunch of public amenities that are happening here that are going to get emboldened by this development project. And then on top of that, around here, it's like the healthcare district, right? Like this is where all the big medical centers are down in this South side, right? So this housing, as I look at it, I think this is perfect housing for nurses, for X-ray technicians, right? The people that are making 50, 60 grand a year and serving and serving the healthcare district and or working in these big condo projects and whatnot is kind of like the perfect demographic for living in a JWB home, right?
Absolutely. Right. Great incomes. Right. The rent on this home on Spring Glen is $1,700 a month. Right. That is absolutely great income, a great type of a job. The healthcare worker profession. We love our healthcare workers, and they would love to be able to live 4 to 5 miles away from where they go to work and to be only have to pay $1,700 a month in rent.
Yep. Yeah. Makes a lot of sense, man. All right, GC, let's go back to the property itself. I'm going to take control over here and share the evaluation. By the way, Raul, way to contribute to the call, right? Like I didn't say this. I normally do. Oh, you know what? Let's do a roll call of everybody that's donated. Lydia Filson donated $100.
Woohoo.
Who else we got? We got Jen and Renee. I know Nadeem donated. I know Ken Moline donated. I know Lee donated.
I remember.
Who?
John Henning.
John Henning, Chris Gonzaga donated. Ken Moline donated 100 each for him and Carolyn. So that's nice. Who else? Denny donated. Who else am I missing? Who have I not given love to that if you donated, put your name in the chat. I'm just kind of scrolling through this, but I also want to give Hervé. Let's not forget my boy, my buddy Hervé.
Don't mess with Hervé. You've already messed with him enough. Okay.
I'm done with that, man. I want peace and coexistence with him. All right. So Raul, good job contributing to the call. We like to say this is an interactive call. We want questions coming in. Best place to put a question is in the Q&A because as you see, that chat flies a lot. Marilyn donated as well. Of course, Marilyn, we announced your name too. Put it in the Q&A is the best place. I'll try to catch him in the chat as well, but we want you contributing. And we got a couple questions from Jen Filson. But before we get to the questions from Jen, Pablo forgot me again. Hervé, I can't win with you, man. It's the worst. You just got to come to the golf tournament. We got to hang out and we'll bury the hatchet, buddy. All right. So GC, before we get into the questions, the great questions that Jen submitted ahead of time, talk to me about this total monthly cash flow, man. Explain the total monthly cash flow number and explain the total ROI, but start with monthly cash flow.
Absolutely. It's a little bit blurry too, bud. So why don't you zoom on in there, my friend?
We are zooming.
Perfect, man. So total monthly cash flow. Right. The reason why I love investing in rental properties, the first reason is that I'm looking for risk mitigation. I'm a conservative guy. That is the first thing that attracted me. If you showed me an investment that I can earn 100% on my money and all of that, it's probably going to scare me. But if you talk to me, you say, hey, listen, I got this asset that's going to pay for itself every single month, then I'm interested. Right. So the first thing I look at is, does this asset pay for itself? When you're looking at total monthly cash flow, that's what that's reflecting. So it's estimated at $171 a month. That means that the rental income minus the expenses that happen every single month is going to leave you with net positive. And that's the first and most important thing when it comes to investing in rental properties, is making sure that you're investing in assets, not liabilities, right? And most other asset classes you go to, you put your money into something and it doesn't give you any money on a monthly basis, right? So that's not bringing you cash flow. In this investment, you can buy an asset that pays you every single month to the tune of 150 or $200 a month. And that's really, really critical, not just because we like to get money rather than give money or to receive money rather than pay for expenses. It's also even more important as you're working into your journey of owning rental properties, knowing that you need to have multiples. Most of you have a goal that's going to dictate that you need to have 3, 5, 10 rental properties. Well, think how important this risk mitigation is, this positive monthly cash flow is when you have 3 or 5 or 10, so that you have thousands of dollars coming in every single month rather than thousands of dollars going out. So that's total monthly cash flow. And to calculate that, you just take the gross monthly income, subtract your principal, interest, taxes, and insurance costs that happen every single month, and also subtract out your monthly property management fees. Those happen every single month when your house is rented. And that's how you'll get that $171 number.
There you go. So the typical experience that you feel at the beginning of the month or at the end of the month, right, with this home is going to be $171 in your pocket. And that $171 serves to mitigate risk because you have a little bit of cash flow coming in every single month. It makes it so that as you try to scale this investment, you're not dipping further and further into your coffers. Instead, it's paying you forward. And kind of like how Tim Hicks famously now has stated, worst comes to worst. As long as you got that positive cash flow, Worst comes to worst, your tenant is paying down your debt every single month, and therefore your risk is mitigated. So what is the difference between that and this estimated conventional financing total ROI of 7.75%?
So the positive cash flow, in my opinion, is like the entrance to the dance, right? To consider a rental property, you got to have positive cash flow, but it's not the only thing to pay attention to, right? There are ways that you can have positive cash flow, but your overall return on your investment is not that high, right? As investors, at the end of the day, our job is to make our money work hard for us. And the greatest measure and the best measure of how hard your money is working for you is what is your return on your investment. So that's what we're looking at with the 7.75% estimated return on investment. That's saying for the money that I put into the deal, how hard is that money working for me? And right now the market is bearing 6%, 7%, sometimes close to 8% just on the cash flows, just on the things that we can control and have a high degree of control over, which would be the cash flows, which is the net rental income, like we just talked about, including all of the expenses. It also includes tax savings, which happens every single year. And you get special tax advantages for being in rental properties that all of you can use. You don't have to be a real estate professional. And then the principal pay down component, just like we talked about with Tim Hicks, right? This is the fact that when you invest in a positive cash flow investment, and you have a resident that pays you every single month, when you pay that mortgage payment, that resident is actually paying down your loan for you, because as a part of that payment, it's your loan, it's your principal balance. Well, you do this every month. And after 5 years, 10 years, 15, 20 years, you're going to wind up one day and see a significantly lower loan balance. And all of that is just equity now in your investment. And that is a real return. Ask me how I know. I've had the blessing to be able to invest for 15 years. I've lived this. Right? And you all can live it too, as long as you're in the game for a full market cycle. So you take all those good things, right? Principal pay down, tax savings, net rental income. You take into account the bad things too. You take into account the maintenance costs that are going to come, the vacancy costs that are going to come, the tenant placement fees that your property manager, JWB, is going to earn when we put a new resident in your home. Take all of those costs into account, including closing costs, and you divide it by your initial investment. And that's how you find out your total return on investment and really how hard your money is working for you. And right now, 6 to 8% is what the market's bearing, and that's a win.
There you go. All right. So that is the 5 profit centers, the total picture that has to do with all of the costs and all the profit centers, except for one very notable profit center, right? Because we have appreciation here at 0. Before that, shout out to Misty Johnson, who just donated $200, $100 per house. Thank you, Misty.
Ooh, Misty, thank you so much. That's amazing.
I mean, I haven't done the math here, but I'm assuming that we've made at least that 4,400 left. I'm sure we've raised at least $1,400 on this call at this point, right?
Yeah.
Like at least 14 people have given $100.
Oh, this is amazing. Do you think we can get to $2,000? Do you think we get like pretty much like close to halfway to our goal on the show here? This would be amazing. You know what? I just thought of this literally. A teammate shared we're going to be making a push with some of our friends and clients and family and whatnot. I said, let me mention it on the show. I had no clue that we would be able to get $1,000, $1,400. And if we can get close to $2,000, this is amazing. Thank you, guys.
You better dial up that shirt order, buddy. Cause I think,
buddy.
I think we're giving out some shirts. I love it. All right. So we just explained that piece. We have not talked about appreciation, right? Appreciation here is listed at 0%. Right now, I'm going to encourage anybody that has questions on this property or any of these numbers or anything that they want to see, start queuing up your questions for Q&A, because we're going to go into that as soon as Greg does his favorite magic trick. All right, tell us about appreciation, Greg.
This is my favorite magic trick. So appreciation is something that most investors don't know how to evaluate. It is a nuanced point that you got to understand if you're going to maximize your return on your investment in real estate. Prior to the Great Recession, most people thought that real estate appreciated every single year. The chairman of the Federal Reserve said that real estate appreciated every single year, right? There was a lack of perspective, a lack of understanding across the entire country and probably the world, right? So people thought that real estate went up in value every single year. Post 2007, 2008, 2010, 2011, right? When the Great Recession happened, post 2007, we realized that wasn't the case. Values went down. And now after that point, from 2011 to 2021, I still hear it when I'm talking with my sales team who's talking to potential clients out there. People still say, listen, when I'm evaluating real estate, I am not going to put any thought into what potential appreciation is because I can't count on it. And so what happened was we have gone so far through the spectrum, down the spectrum. This pendulum has swung so far. In the beginning, everybody said real estate appreciates every year, which is not true. And now, as an economy, as an asset, as an investor in this asset class, most people say, I'm not going to pay any attention to home price appreciation. But that's wrong as well. The reality is that real estate values follow a cycle, and giving 10 to 20-year segments of time, you see that the historically accurate home price appreciation rate actually repeats itself in your market. So in Jacksonville since 1991, every year on average, we've appreciated 4.3%. And so if you take 10 or 20 year segments of time from today going forward, you can count on home price appreciation if you are in for a full market cycle. And the reason why you need to be paying attention to this is because out of those 5 profit centers that we just talked about, right? Out of the 5 profit centers, most people pay attention to cash flow. They pay attention to one, and they make all of their decisions based on one. But when you look down at the breakdown of your total return on investment from all 5 profit centers, cash flow many times is the smallest contributor. The largest contributor is home price appreciation. So if you're only looking at cash flow, could you possibly make the best decision for yourself over a full market cycle if you're not paying attention to home price appreciation? Answer is no. So you got to understand this. You got to look at this so that you can put your money in the right market so that you can win from all 5 profit centers.
All right. So if you're in it for the long haul and you're in it for the right market, which is Jacksonville, and you do it, we put in 4.3% appreciation. You can do this yourself at home, or put whatever appreciation in whatever, market with less appreciation like Cleveland that you're looking at some kind of property in. And when you hit enter, boom, jumps up magically 16%. GC, explain the show us behind the veil. Tell us why the magic happened.
This is the most beautiful part of the magic trick right here, right? This is the beautiful part of smart debt. Smart debt is when you can take out a loan on something that pays for itself, like rental properties do, positive cash flow, that has low terms, like rental properties do, where you can get interest rates at like 4% right now, and historically goes up in value. Those are the 3 things, like we just talked about. Real estate, if you give it long enough of a cycle, goes up in value. So if you can take out debt on an asset like that with those 3 characteristics, pays for itself, great terms, low interest rates and great terms, and historically goes up on value, you can really win in rental property investing. And what I mean by that is when your market value goes up 4%, when it appreciates 4%, that doesn't mean your return on investment from appreciation is 4%. If you buy it in cash, your return on investment from appreciation is 4%. But when you use other people's money and you only put 25% down, pick up your phones right now if you haven't done this exercise yet. Do 4 divided by 25. You'll get 16%. Okay. That means that your 4% appreciation on the asset really is a 16% return on the money because you only put 25% down. That's what's happening here on this evaluation. That's why it jumped up from roughly 7.75% close to 24%.
There you go. The power of leverage, right? Like the idea that in this specific asset class, you stand to gain by putting not the entire bit of the money on the table, but you get to get the interest and the appreciation benefits of the entire piece of the pie, right? All right, man. I love it. I love it. So got a shout out to Bill Shields with his Buenas tardes, amigos. He said he just put in $1,000.
What?
Yeah.
No way. Bill.
Amazing. Incredible.
Oh man, that's amazing. Bill, yeah. You all have made my day today. Thank you so much to Bill and to everyone who has donated. This is just beyond words. I just am so thankful.
It's very cool, man. It's cool to be a part of it. All right, GC. So we just showed the numbers. We showed everything else. Quick question. I have to assume that I know that non-recourse rates went down as far as lending, but I have to assume that 8.4% might be maybe the hyphen is the period's not in the right place, or there's a problem with that formula, or is there really this 8.4% on non-recourse financing right now?
Well, that's the return on investment, because it's still, I think it's 50%. I don't know if this evaluation has been updated.
Okay.
So I'm not sure about that, but that's going to be pretty accurate for what your expected return on investment will be, including home price appreciation.
Right? Oh, that's right. Because I put this down. All right. So let me take that away.
Yeah.
Yeah. Okay.
Yeah.
Okay. That was what blew my mind. All right. Cool.
It's been a little while since I've screwed up an evaluation, but it's going to happen again sometime soon.
It'll happen. All right, man. So let's go into Jen's questions that she had already, that she filled in ahead of time. We love it, by the way. If you send in questions ahead of time, we'll get to them on the show in case you can't make it. Love the questions. You are what makes this show special, right? So Jen has 3 questions. Number 1, how many properties can one person buy? Is there a limit?
Well, there is no limit. And that is a great question, Jen. Many people hear of a limit, and I'll explain what they are hearing. But at the end of the day, there is no limit, right? You guys know my story, right? I love rental property investing. I've been doing it since 2006. I own over 300 rental properties along with my business partners today. So there absolutely is no limit. And what people are talking about when you hear that there's a limit, there is a limit to the amount of Fannie Mae or Freddie Mac loans that you can get. So people hear that and they think, well, then I can't buy anymore because I can't get a certain type of loan. And Fannie loans and Freddie loans are the best types of loans to get. They give you the best terms because they are government backed. And so right now there is a limit of 10 Fannie or Freddie loans that you can have on your credit. But the reality is that there are many other loan products, and there's many other ways to be able to buy properties. You can buy properties in cash. You don't have to have a loan on it. You could have a loan with a private lender that does not go onto your credit. You could have a loan with a non-conventional lender. So, and then there are strategies to where you can get even above 10 properties, 10 Fannie and Freddie loans within your family. Have you heard about that one yet, Pablo?
I haven't. Tell me more.
No, this really applies to you and Marta. We may have talked about it on a run or whatnot. So the way that Fannie and Freddie, this 10 limit works, this 10 limit of loans on your credit report, it's based on your individual credit report. So let's go for you and Marta, Pablo. If you buy your property, and for your properties, did you buy them in both of your names or just in your name?
We bought the first one under both of our names, and then we wised up a bit and we got the second one under Marta.
There we go. Okay. So the first property is in your name, and the loan, I would imagine, is in both of your names.
The first property is under both of our names, and the loan is under both of our names.
Oh, okay. So that takes up.
Yeah. Go ahead.
Yep. And then the second one is just in Marta's name under Marta's credit. Okay. So this is great, right? This is a great example. The first property that Pablo bought now is taking up a loan spot on Marta's credit, as well as a loan spot on his credit. That is taking one spot away from them, in their 10 that they could have. And it's 10 per individual. It's not per family. So in theory, Pablo and Marta could have a total of 20 properties if they bought them individually and the loans were just in their name. They could get up to 20 Fannie and Freddie loans through doing that strategically. And now on the next property that Pablo bought, probably had that conversation, and now it's just under Marta's name as wife. And that way that frees up additional loan spots so that maybe the next property that they buy might go under Pablo's name and the loan might be under his name. This is very common. And we work out this strategy we do it on our buying plan calls with our clients that we get onboarded even before we actually buy properties, to make sure that this strategy is right for you and you can maximize those loan spots.
Yes. All right. So I was paying attention to the chat, and Lee was talking about how he used to play volleyball with a 2-beer hat, and I got distracted. But yes, now that you talk about it, yeah, we have talked about this on our runs of you can get up to 10. And Jen's follow-up question was this idea of, can we exceed that number of 10 per person to hit our financial goals? You want to kind of explain what happens once you go beyond the Freddie and Fannie loans?
Yes, absolutely. So, the first thing that we want to do is to maximize the loan spots to get you up to 20 between your family. So we're going to work hard to do that. Let's assume that either that's not possible maybe a spouse can't qualify on their own, or maybe you're over 20. What do you do next? Well, there are a number of non-conventional loan products that our lenders have access to. So a non-conventional loan product just means it's a lender that isn't backed by Fannie or Freddie. Like they don't sell that loan to Fannie or Freddie. So they don't have to abide by whatever guidelines Fannie and Freddie have. They can create their own guidelines. And their guidelines might be the exact same as Fannie or Freddie, but they just don't limit it to 10 finance purchases on a borrower's credit. So there's a lot of lenders like that. Now, their terms, as you would imagine, will not be as great as Fannie and Freddie, right? They'll be somewhat close. They'll be good enough to still have positive cash flow many times, still be able to take advantage of all 5 profit centers. So that's the next step for us with our clients. When we see that they're over 10 finance properties or they can't get a Fannie loan for whatever reason, then we set them up within our network of lenders to investigate and to see about non-conventional loans. And then if that doesn't happen, there's a number of other ways, right? Non-recourse loans are the next step. Non-recourse loans are going to be a little bit more expensive, but there's less requirements. Qualifying is even easier because they're really qualifying JWB and the asset more than the borrower, but those are more expensive loan terms. So that's the third line of defense. And even beyond that, there's a number of ways to be able to raise money yourself. We always look at, home equity lines of credit as an opportunity for folks to be able to tap into the equity on their home in a smart, risk mitigated way to be able to buy their future portfolio. We also look at retirement accounts. That's another thing that people are sitting on assets that might not be performing that could be turned into rental properties. So all of that is a part of the buying plan conversation. And you really don't need, in my opinion, for most folks, you're not going to buy 10 right off the bat, right? You're going to get in, you're going to buy 3 or 2 or 1 or 5 or whatever the number is, right? You're going to get your feet wet. And generally, you're going to have time to figure out the best source of that next, round of ideal financing for you. And we're going to be with you every step of the way. So I wouldn't be concerned right off the bat as far as getting limited.
Yeah. And Jen is putting here, I would hope that when we own 18 properties, we can use the equity to buy more homes via non-conventional loan means, right? And Chris Gonzaga, he just put portfolio lender. Do you want to explain what a portfolio lender is?
Yeah. So a portfolio lender is a non-conventional lender that basically makes loans and then keeps them in their own portfolio. So most banks and most lenders make a loan to you, and then they want to abide by the end banks, the end lenders guidelines, because they're going to sell that loan to the end lender, right? It's probably Fannie or Freddie. And then Fannie or Freddie is going to buy that loan. Well, a portfolio lender, their business or a part of their business is to make loans and to hold on to them, to service the loan, to hold on to the loan. They are not there to then go and sell that loan to another lender. And that's great. For those portfolio lenders, they can make up their own rules and guidelines. And, for me, the 10 finance property rule, it's the way it's been for a while now, probably, 10 years. It wasn't always that way, though. People don't realize this. When I started to invest in 2006, there was no limit to the amount of finance properties you could buy. And then it went to 4, and now it's to 10 again. So it's not a rule that it has to be 10. I of course would love for that rule to change, but there are certainly a lot of other options. A portfolio lender is one of those options.
Got it. All right, man. So, what I would love to, what we haven't hit on in a while, GC, this is a new construction home that we're talking about here, right? So I'm going to share it again. We got this thing is currently under construction, and this is a typical floor unit for JWB, right? Like this is something that y'all have built multiple times. Can you talk about the difference between the experience of purchasing a new construction home like this versus a renovated home?
Well, the experience, there's really not a lot of opportunities to buy renovated homes today. Hopefully this doesn't surprise anybody. We have been talking about this dynamic for as long as we've been doing the show. The fact that as prices go up, makes it harder for companies like JWB to be able to buy a renovated property, to buy existing inventory at a price where we can still make a cash flow for you. As prices go up, those opportunities are less and less. So I think, I don't know the last time that a renovated home became available. It's very, very few and far between. Over 90% of what we're selling is new construction. So with new construction, there's a lot of benefits to it. One of the downsides to new construction, though, will be the timeline, right? As you can see in this property here, it's under construction. All of our properties are put under contract while they're under construction. And so your actual closing date will be 3 to 4 months or so from the date that you put it under contract. I would love for that to be less, but that's just the state of things. Sales are just on fire for JWB and for the real estate market overall. So that's going to be something that's a little bit different if you're buying new construction. In theory, if you can buy a renovation, your returns are going to be very similar, right? Your short-term returns and your long-term returns between new construction and renovations are going to be very similar. Your renovations will just not going to look, it's brand new, right? They're a renovated home built in the 40s or 50s or 60s. You're going to have slightly higher maintenance costs on a renovated home than a new construction home, but your price points are going to be slightly lower for renovations. Hopefully all that makes sense, right? New construction sells for a higher price point. It's newer, and generally the homes are bigger with garages and whatnot. But if you do get the chance to buy a renovated home, you can close much quicker, right? So a typical renovation might take 30 days. We'll make the home available while it's under renovation. Maybe it's 30 days, maybe it's 60 days, depending on the size of the renovation. But you're looking at maybe a couple of months to close versus 4 months to close. And so it's going to be a quicker process.
Got it. And as far as how it shows up on this sheet, right? Like we've seen in the past, it kind of shows up here, right? In the maintenance rate.
Mm-hmm. Yes. Good point. So yeah. So for your new construction, well, and let me just take a step back. The way that we get these maintenance rates and vacancy rates are so important. They can swing the numbers so substantially. If you're thinking about buying a rental property, you can make it look really great by having low maintenance and vacancy. Many turnkey providers don't even put maintenance and vacancy into their evaluation. I've never seen that. I own over 300 rental properties. I've never had one that didn't have any maintenance or vacancy. So, and then, if you work with a provider that actually puts really high maintenance and vacancy numbers in there, you're going to see your returns are really low. So that should just signify, how important it is to choose the right property manager, because your property manager is there to mitigate the risk of maintenance and vacancy. So for us, we are the only provider in the entire country, in the entire world. I've never met another provider who actually tracks maintenance and vacancy cost. We have tracked every dollar in and every dollar out since 2011, over 2,000 rental properties that our clients have purchased from us. And we look and we say, how are we performing when it comes to an average maintenance rate, an average maintenance percentage, or an average vacancy percentage? And we take that and we put it onto our evaluations. And so for new construction properties, our data, real data, shows that we're performing at about a 4% average maintenance rate per year. So 4% of the rents that are collected on an annual basis, you should plan on giving that back in terms of maintenance costs. And for vacancy, it's 3%. On the renovation side, right, it's going to be slightly higher. It's not a whole lot higher. It's going to be slightly higher. So 6% is the expected maintenance rate for a renovated home, and vacancy is 4%. So that's all factored into your evaluations. And the way it magically works out is that because you have a lower price for renovations, but you have higher maintenance costs, slightly higher maintenance costs, you're going to get to that same 6 to 8% return figure before appreciation. And that's why we love them both.
There you go. And all that is, that's all taken into account in this total ROI, right? Like all that stuff is calculated in here.
Absolutely.
All right, man. I thought that was a pretty good explanation, GC. We don't have any more questions. I think we're going to wrap it up early today. This was a lot of fun. I loved raising 22. I think Lee did the math, right? So if you're just joining us, right, you want to kind of, just in case somebody joined us late, you want to tell them about the raffle, the sponsorship, what you're doing, and just one final call to action. We'll give the final number of what we raised here.
Absolutely. So the single best day of the year for our company is the day that JWB gets to build a new construction home and then give it away to a very deserving person in our community. And for 4 years now, JWB Cares has been raising money to be able to support organizations here locally. Our sponsor, our key partnership has been Canines for Warriors for the last 4 years. And through that partnership, we have built 3 brand new construction homes and given those 3 homes to 3 very deserving veterans here locally and have absolutely changed their lives. And our goal through JWB Cares, through our company, is to be able to do more. And we ask for support from all of you and from all of our clients and from all of our network and from all of our sponsors to sponsor the JWB golf tournament, which happens in February of next year. And we ask for donations from clients as well. And clients show up in such an amazing force that we're able to do some really great good, some really great things. So the thing that we are challenging ourselves and challenging all of you is to help us build 2 homes in February of next year, to give 2 homes to two very deserving people in our community. Our partnership with Canines for Warriors continues to be very strong. We love working with that organization. And so they're going to select a veteran for us to give the home away to. So that'll happen in February next year. But we're here to raise money to help us do more than just that one. We're just announcing our partnership with the Tim Tebow Foundation. And so we're committed to building a second new construction home and giving that home to somebody in the Tim Tebow Foundation who is suffering from human trafficking or who has suffered, to be able to give them a safe place to live. And so your dollars go directly to building this new construction home. And we're going to be able to share their stories with you all the way from now until the golf tournament, until the home donations next year. So we have raised almost, let's say, I can't do the math here real quick, but over
$2,200 is what we've raised today.
We've raised $2,200.
Well, tell them where we started and then, give them those numbers.
Well, we were $4,400 short of our goal of $100,000 raised in 2021. That's through our sponsors, through our clients, through our team, through JWB, everybody coming together. Our goal was to raise $100,000. We started this show being $4,400 away, and you guys have just stepped up. You guys have donated $2,200. Is that the right number?
$200 is the number.
Oh, guys, I just don't even know what to say. I mean, it's really amazing. Just so thankful for this community. Times like this is just this community means a lot. It really means a lot to our team. So thank you all from the bottom of our hearts. If you would like to continue this amazing train of donation, you can go to jwbcares.org/sponsor, jwbcares.org/sponsor, and you can go and donate. And for everybody who donates, their a Not Your Average Investor Show polo, which Jen Filzen and Renee, her husband, put these polos together. So we're going to get one of these polos to everybody who has donated here on the show. And if you're doing it now, and listen, we'll open it up for the next 30 minutes after the show, you're still going to get a polo. And just thank you. Thank you, guys.
I'm going to go ahead and just say, and you listener that's listening on the podcast right now, in the future, in your ears, that comes out in a week, you can still donate. And if you shoot Gregg an email, he'll get you a polo. How about that? If you're listening on the podcast.
And then join us live on the show next time. If you're listening on the podcast, you can register at jwbshow.com and then you can be here live for it next time.
GC, what's coming up next week, man? We got best Florida neighborhoods to invest in. I know you're pumped up about that one.
Dude, we have some amazing things to talk about next Tuesday for everybody on the show. It's awesome that you guys stick around to the very end too, because next Tuesday I have some information that is going to shock some of you. There is this stigma against investing in below middle income neighborhoods. In terms of growth, in terms of home price appreciation, people come in with the idea that home price appreciation only happens in the better looking neighborhoods. And I challenge people to invest by the numbers and not with their eyes. And so there is some incredible information that was just released. The fastest growing neighborhoods in the state of Florida. And I will just share with you, well, how much do I give away before? Like, do I just tell them everything, Pablo? I don't know. I don't know how to do this hype, man.
I think you've said enough. We're going to talk about, we're gonna break some myths about investing in low income neighborhoods. We're going to talk about some of the top 10 neighborhoods in the United States to invest in for rental properties. Spoiler alert, some of them may or may not be JWB neighborhoods.
Below middle income, baby. I'm telling you, it's best for risk mitigation and upside.
There you go. There you go. All right, man. This has been a great show. If you are still with us, 24 folks, we had over 30 on the call today. Never, never, never goes without noticing that you took an hour of your day to hang out with us in the middle of a work day. We're incredibly humbled by that idea. The fact that we raised $2,200 on this call today to help veterans, to help survivors of human trafficking has been an incredible thing to be a part of. I can't wait to see you all in the golf tournament, February 2022. In a couple of weeks, we actually have Rory Diamond joining us, who is the CEO of Canines for Warriors, and he's a city councilman. He's going to give us a scoop on everything that's happening, but he's just a freaking great hang. Last time we hung out with him was a lot of fun.
Absolutely.
So that's going to be awesome. As we like to say, if you came to learn about rental property investing, you were in the right place. If you came to find out about the best in class property management for rental property investors, you were in the right place. If you came to find an edge in the Florida market because you're a real estate professional, you're in the right place. Next place to go to chatwithjwb.com, book a call, hop on with Courtney and the team. You're going to learn even more that's more contextualized to your situation. I am incredibly grateful to be a part of all of this. GC, I'll give you last call.
Thank you. Thank you all from the bottom of my heart. Thank you for making this community so special. It's times like this that show me that it's not just about the real estate that we're talking about here. It's about changing people's lives. And that's a message that everybody in this rallies around and believes. And I'm just happy to be a part of it. Thank you, guys.
See you next week.